we got to take question 3. And this was from Josh, and Josh should ask some live questions too. We might get a chance to look at a couple of those too. Question 3 from Josh is, in my current strategy covered calls, I'm joining your algorithm that seems to find mispriced sweet spots. At least that's how I tend to see it as a new subscriber, using the picks of the day, weekly or monthly picks of the day. And Josh says, can you please address the viability of using leaps to lessen the cost of engaging covered calls? Buy a leap and sell a short-term covered call versus buying 100 shares, and how your service would help find setups and trades. Okay, well, first things first, let's get the terminology. Some refer to this as, quote-unquote, the poor man's covered call. That's the popular, trendy, salesy way to describe the leap strategy you're referring to, Josh. I don't like to use that term. We're going to see why in a moment. The real term, what we're talking about here, is a calendar spread, a diagonal calendar spread, not horizontal or a diagonal spread. Let's look at power options. Let's look at the ins and outs, the risk and rewards, and the preferred, though maybe not maximized, criteria that we use for the calendar call screen, quote-unquote, poor man's covered call, and much more. Before we jump into the calendar call screen, the calendar call search for Josh, I want to just build a calendar call on the fly, and hopefully this points us to one of the issues that I want to illustrate. If not, that's okay. We're going to be able to illustrate it anyway. Well, we talked about AbbVie a little bit. It's up in price. We looked at AMD that's had the big run. I think I'm going to stay with that. I'm going to go to the custom spread tool first. And we're going to take AMD. And of course, we know I could buy 100 shares of AMD right now. And let's just go ahead and sell a 2-week out call, 14 days out in time, 13 days out in time to March 28th. I want to be slightly out of the money to get some good premium, leave some upside. This looks good, about $4.50 for the 200 call. A little bit of breadth, a little bit of upside room, and at slightly out of the money covered call. Not a lot of protection, downside protection, but hey, going to have a good potential return. Let's just put this easy at $4.50. Now, of course, as we know, out of the money covered call position, this is not what Josh would have been seeing with the weekly or monthly picks of the day. Those are slightly in the money with the goal of being assigned. But here we have a nice little covered call. We got about a $4.50 protection, downside protection. It's not a lot against a $191 stock, I know. But if it's above our strike price, we get assigned at 7.2%. We've lowered our cost basis down to about $186.60 with the premium we generated for the call. If the stock is anywhere above 200, what happens? We get assigned, we make the maximum return on the trade. 7.2% or $1,344. That's the point of a covered call. If I sold the at the money, the 190, we'd have a much lower return potentially because we're not gaining any of this intrinsic between 191 and 200, but we'd get a higher premium. So we might be looking at a 4% return as long as the stock is anywhere above 190 in that scenario. And you know the return, right? If it's above 190, I make the premium. If it's above 200, I get assigned at 200. I make that extra premium plus the $4.50 I collected. That's my 7.2% return for 14 days. Now, let's swap that out. I don't want to trade the stock. I don't want to put $19,106 to trade this position. I want to go out in time, maybe to January, maybe not as far, maybe to October, but let's go to January, 308 days out in time. Rather than buying the stock at 191, I'm going to buy the right, to buy shares of AMD at 150, and I'm only going to pay about $60. I'm paying a third of the cost, and I could go to 180, but we're going to go in the money here to the 150 strike at about $60 while still selling that same call. I'm going to save $12,000, $13,000. I'm only going to pay $6,000 instead of the $19,100 we would have paid to buy 100 shares of stock for an even ratio. Cost basis now is only $55.85. Max return is 19.8%. Still $1,100, close to that $1,300 we had by selling the 200 call against the 100 shares of stock. Now, this isn't as bad as it could have been. But here are some of the pros and cons right away, and why I personally do not like to use the term poor man's covered call. Remember in our covered call example, if the stock was above 200 on the covered call, anywhere, had a large run up to 220, 240, 260. Likely? I don't know. Unlikely? Stock moved from $96 to $150 real fast. We could see another AI run. That's a potential, Josh. It could absolutely happen. But what's going on here? In the covered call, I made 7.4%. In the poor man's covered call, the diagonal calendar call spread, if the stock is above my short call strike price, my profit is trailing off. I'm only making here about $250, $350. Okay, more realistic, at 220, we're only making about $750, not $1,100, and about half of the $1,300 monetarily we'd make on the covered call for the lower cost basis. I don't like using the term poor man's covered call. So when this started coming out years ago, a lot of investors who thought it was the fantastic idea to trade this strategy just assumed that if it was anywhere above their short call strike price, they'd make this return of 19.8%. That's not what happens in a calendar spread. I'm not going to talk about it right now. We're going to talk about it, Josh, don't worry. But I want to talk about some other things before we get into why this is happening and what you'd have to watch out for in this strategy. What I was hoping I would see, and it didn't appear in this case, but it does appear a lot it might appear with NVIDIA. We might take a look at that later. But another thing can happen with these calendar calls if you're not careful with what you're doing, and I'm going to show you how to be careful with what you're doing, is that you can actually have two ways to lose. And you can actually lose more to the upside than you can to the downside if you're not properly structured. Meaning that if you overpay for your leap call or your far out call to a point where, this isn't as bad either, but the point where the net debit is greater than the difference in your strike prices, you can actually see, and here's not too bad either, at 250 you're starting to see loss. You have an upper and lower break even, and your profit in this range is not that strong. Now you're looking at $270 here at 210, 360. That's an improper structure. And I've seen examples where investors have come up to me and say, hey, I really like this stock. Sometimes it's a biotech stock, sometimes it's another stock. And I've got this great calendar spread where I did this, and I look at the position and I just say to myself, what are you trying to do? Your potential profit here is very minimum, and I understand it. It's a $300 stock, and you're only paying $60 to do this or $50 to do this. Your structure is not what I'd call a minimum window of profit in 14 days of 10 points on a stock like AMD or even a more volatile security. That's not the structure that you want. Okay, now thankfully, that's why PowerOptions helps. We go into calendar call, Josh. We go into search. Take a sip of Cabernet. And here we have some calendar spreads here. It's LW at 102.06, selling an April 115 call. 35 days out. This is more of a monthly screen. And buying 280 day out 95 strike. Max return if assigned is 68.8%, downside protection of only 4.8%. Okay, now I'd prefer probably to go with this setup on LW. Now this is the initial values screen. And there's some other defaults there, limit debit to 20 points, calendar leaps, number one. An old company we used to work with, Compound Stock Earnings, they have some default screens there as well. I'd say you're going to focus for safety on calendar leaps, number one, or the initial values. Don't do the same strike spreads. That's a horizontal spread. That's an entirely different animal that it doesn't do what you want. Okay? Now, before I make some suggestions of what I do, how I adjust my criteria, as I mentioned, this one isn't maximized. I keep changing this. I love this strategy. You've heard me say, even last week, that I usually have 10 to 15% of my portfolio, not only in bull put credit spreads, but also in calendar calls. Poor man's covered calls, but I'm going to use the term diagonal calendar calls or calendar calls when I reference it. Because there are stocks, just like we looked at AMD, I wouldn't buy that as a married put now because I already have 4 or 5 other positions open. And I don't want to put $19,000 into it to do 100 shares. I would be doing AMD right now personally as a diagonal call spread. NVIDIA, absolutely. Chipotle, when it was going on its tear, I was using that as a calendar call spread, not as a married put, not as a covered call position. Different market conditions, different things. Now you start playing around with some things you need to be aware of. Potentially the implied volatility ratio, the implied volatility of the sell option divided by the implied volatility of the bought option. I usually want the implied volatility ratio to be greater than 1 or greater than 1.1. I want a little bit more juice in the call that I'm selling as opposed to call that I'm buying. Now, I would tend to limit this also, the out of the money range to be less than 3%, maybe less than 4%, with the same other criteria. Max return 4 to 100, debit less than $15. That's a personal preference. That's what I like to use. Other ratios, the delta ratio of greater than 0.6. Oh, that's the long option delta. Strike that, reverse it. I want to be in the money, but I don't want to be so far in the money. We'll talk about that in a moment too. I don't want a delta of 0.95 or greater because I know what you're trying to do. You're trying to find a leap call or call with a high delta that mimics the 1 point movement of the stock. We're going to take a look at an option chain to view that later on the trade that comes up. But when you look for those deltas and you're trying to find something that's a year out in time with a delta of 0.97, 0.98 or closer to 1, there's no open interest. There's no current or recent volume of any kind. Those options aren't getting traded. You've got to be in the tradable range as well. But yes, you can still find a good delta of 0.75, 0.8, 0.85 as well. Okay. Now, delta ratio of 2.0. This is the delta of the buy option divided by the delta of the short option. What does that mean? It means the option that I'm buying, as we can see, I want a delta of at least 0.6, 0.8 on the one that I'm buying. Oops, sorry about that. 0.8 on the one that I'm buying. So that means to get the delta ratio of 2, the delta of my short option, which is at or slightly out of the money, has to be less than 0.4 or less than 0.3. Why is that important? Because if the stock moves up 1 point, I want to see an increase twice as much in theory on my long option that I may have to pay back, Josh, into the short option. Those are the working deltas. If I have a delta of 0.3 on the out of the money call I sold and a delta of only 0.6 on the one that I bought and the stock moves up 1 point, I should be gaining 60 cents on my long, but only losing 30 cents on the short. Delta ratio of 2. Now, that's going to keep changing during the trade. I'm not managing to keep that delta ratio the same. I'm not playing a gamma hedge with my calendar spreads or, a delta hedge trying to stay delta something, delta X or delta Y or delta neutral. I'm not doing that. I'm looking at it for growth on a position that I don't want to pay the money for as a married put or a covered call position. And that's what I'm looking for. All right. Now, most important criteria that's here in the defaults is the debit to strike difference ratio of less than 1. What I just illustrated in the profit and loss chart that we looked at, when you can have 2 ways to lose on your calendar spread because of the improper structure, all of the positions you see in this default initial value screen are going to have that net debit to the difference in strike ratio of less than 1, meaning your debit is always less than the difference in strikes. That's important for 2 reasons. Number 1, you typically don't see an upper and lower break even on your position. Number 2, the risk of early assignment. Even if the stock runs up and you're suddenly assigned early on your short call, your broker's not going to let you sell to close the long call. That's important. They're going to exercise your long call to deliver the short obligation, so you at least get some profit back. What do I mean by some profit? Why won't you get the maximum profit? We're going to talk about that in a moment as well. Now, I made a couple quick tweaks to this, changed the out of the money range and so forth. Oops. What did I change other than that? Okay, no, I got to give this at least about 5 or 6% based on my delta ratio. Might have had to adjust my delta ratio slightly. Oh, okay, I'm sorry. There we go. Okay. So, Morgan Stanley Citigroup, doesn't surprise me that we're seeing a lot of banks here, but let's take, sorry folks, let's take the first Morgan Stanley that comes up, stock at 88.38, 35 days out, 92.5 strike, and buying the in the money 80 strike. Short option, 0.69 for the long option to 0.31, implied volatility ratio of 0.91. Okay, perfectly fine. Debit of 12.16 on, so close though, 12.15 spread, but a 32.2% max return with a 10% downside protection. That's at least what I look for usually as well. Okay. Stock aside, technicals aside, Josh, let's take a look at what I want to see for the profit and loss chart. Does it match what we want? Absolutely. Now, let's talk about this chart at expiration of the short option, April 19th, 35 days away. Fantastic. Okay, let's see. Oh, yeah, 0.26. I'm going to change this real quick to 0.2640. I'm going to explain that in a minute, too. That's a little bit more detailed, but just to do this, we're going to take a look at this one here. Okay. Now, you know what? I apologize. I want to take a look at something else here. Let me try the Citigroup one. I'll explain that, too, but let's get back to where I want to be here. Okay, that's not doing what I want it to either. Okay, in any case, let's take a look at the chart at expiration. That's 42 days. I probably shouldn't have used that one. All right. Here we have a simple spread position, a calendar spread. All right. And all right. What do we have here? We have a net debit of 920.50. So we're going to sell. We're going to buy the January 50 call on a $57 stock at 10.50. We're going to sell the 60 strike call at 130 for a net debit of, roughly 920.50. But on a 10-point spread, which is important. Now, the max return is 30.2% at expiration, profit of $278. This is where it differs from the covered call as well. Here's that maximum profit we're looking at the sold option expiration, the peak of the blue line, Josh. That is not based, and this doesn't matter if you're looking at our profit and loss chart, you're looking at Thinkorswim, you're looking at E-Trade, you're looking at Interactive Brokers, you're looking at Tastyworks or Tastytrade. This is the theoretical return. If the stock is trading at the short call strike price at expiration. Why on earth is that important? This is where investors sometimes got into trouble following the path of this term, poor man's covered call. This is a theoretical return. Whereas if I bought the stock at 57.1, sold the 60 strike for $1.30, and it was anywhere above 60, I know exactly what my monetary profit's going to be if I'm assigned. This is theoretical because the best any of us can do is calculate what is the theoretical value of your December 50 strike call if the stock is trading right at $60 or at any of these prices on that nearer term April expiration. It is using the Black-Scholes pricing model to get the theoretical remaining value. And this return, this max return we're seeing today with today's implied volatility for the long option is based on being able to sell to close your 60 strike call for its remaining value. Not assigned. Not exercising the 50 strike to deliver the obligation at 60, because that only gives you 10 points back. And if you had the cost basis of 920, that means your maximum profit, if you allow exercise and assignment, which you would want to do in a covered call, is only 80 cents. Not 30.2% and not 278.34. If I let it go and did nothing and the stock was trading at 62 or 63 at our April expiration in order to cover the obligation that I have. I still have the obligation to deliver 100 shares of stock at 60. That's the obligation of selling the call. I have the right to buy it at 50. But if I go through exercise and assignment, I don't do anything to manage this position on that April 26th expiration, my apologies, then I only make 80 cents. This max peak return is based on being able to sell to close your 50 strike December call at the value at this time. Now, why is the profit, the max profit on the position, not stable and continuous as we would see with a covered call in the quote-unquote poor man's covered call? Why is it trailing off? And that's the magic of expiration in this case, Josh. We looked initially for positions that had a delta ratio of greater than 2.0, meaning that at the start, if the stock moves up 1 point from our current price, I should be expecting to gain twice as much on my long bought call as I'm losing on my negative sold call. It's a negative delta to me because I sold it. At expiration, even though you have a deeper in the money option far out in time, once the stock goes above this strike price, or within a day or two to expiration, if the stock's trading at 62 on the 23rd, 24th, or 25th of April, a few days before expiration, the delta of our sold 60 call is going to a value of 1. It's in the money with 1 or 2 days remaining to expiration. Its delta is getting closer and closer to 1. Even though this option is a lower strike, it's deeper in the money. It's also further out in time. It's probably only at a delta of 0.78, 0.8, 0.85, 0.9. It's lagging. So at this point at the short-term expiration, as your option, your sold option goes in the money, it's going closer to a delta of 1 faster than the long option that you bought. And that's why the return trails off, because now it's costing you more to buy to close this call than the value you're getting back increased on this one. You've now reversed the delta ratio. There's nothing you can do about that. Well, I mean, you're going to roll the call probably to stay in the position and continue selling calls against it as it goes in the money. That's the management technique of the calendar call, diagonal call spread, poor man's covered call. And that's why people get in trouble. Am I saying it's a bad strategy? Absolutely not, Josh. It's something that I use. It's something that I look at, and you can adjust the criteria too to do shorter term trades. I mean, many of mine, I have been making changes. I apologize. To the calendar call spread, where I might only be looking, like I do for my bull puts, maybe only 14 to 20 to 25 days out in time on the sold. And for the long, I'm only going maybe 90 to 210 days out in time, not as far as a leap call. You can do it either way depending on how long you want to stay in the position and what your expectations are. And then let's go ahead and if we see anything there. Yes, we've got some shorter term one. ASO. Oh, that was a married put that I was in Nike. This is interesting here how these are appearing. And I've got some high implied volatility ratios on these positions. There must have been something in the market today or recently with the retail stocks that I missed. ASO was not a great married put for me. I think it worked out to a small profit, but it jumped around with a bad earnings that I was expecting a positive on. By the way, this is something I mentioned. When I kept those longer term ones out, the reason why we weren't seeing any results is because I was looking for an implied volatility ratio of greater than 1. There are positions out there, Josh, that will have that. But right now, the way the market conditions are, the implied volatility of banking stocks, utility stocks, and others, September, October, November, December, and January, their in-the-money implied volatility is actually higher now than the short-term option implied volatility because of recent market conditions and the strength in the movement up and the promise of maybe we're staying neutral and no rate cuts. We might expect one in June, but there's still a lot of uncertainty about what could be going on further out in time. And we're going to also cross 2 or potentially 3 more earnings on some of those positions going out to January and December. So there's still some extra uncertainty, which is why that's up. And we're not seeing as many implied volatility ratios of greater than 1, where we're selling into a higher implied volatility right now than some of the in-the-money options further out in time.